I think there are two catalysts potentially. One is very strong numbers on the inflation side, for example, and the other would be an ECB, which would be perceived as not fully committed to their inflation target, given that they're still showing an inflation projection of 1.4% for 2023. It would be surprising if they scale back support anytime soon.
And when it comes to the ECB, all eyes obviously on this upcoming ECB meeting next week. Is it your view that they will start to slow down the pace of PEPP purchases?
Well, they've said that their goal is to maintain favorable financing conditions without explicitly defining what they mean by that. And if you look at their staff projections, they are showing inflation undershooting their objectives for the next 3 years. So you could make the argument that financial conditions are actually too tight currently in the euro area, and that would argue for maintaining at least the current level of support, i.e. not scaling down the asset purchases. I'm a bit surprised that the debate is only about doing less or maintaining the current stimulus and not about doing more.
Well, Konstantin, we certainly have the ECB angle here and the ECB supporting European fixed income markets. But on the virus front, Europe had been lagging the US and the UK for the start of the year when it comes to vaccinations. But now it looks as though Europe is making a pretty good effort catching up, and case numbers are coming down, vaccinations ramping up. Do you think European fixed income reflects the potential upside in terms of Europe catching up to the US here?
I think so. So if you look at the yield developments in Europe and the US in Q1, you saw that was clearly driven by the US. And there have been some spillovers to European fixed income in driving yields higher. But what you are seeing now is actually, as you alluded to, is that Europe is catching up on the economics data front, on the pandemic developments. So that's why the recent increase in yields has been driven primarily from Europe, not so much by the US.
And on the European economic outlook, do you think that European fixed income markets are pricing in fully the European Recovery Fund, or do you think that there's upside as we look at countries actually moving ahead and implementing their plans for these funds?
I think the Recovery Fund, which has been agreed 1 year ago and now finally ratified by all member states, and probably will kick off issuance from later this month or early next month, is fully priced in. So there could be hiccups in the implementation, that the money is only released against reforms. So there will be a constant monitoring of what countries are actually doing in return for the money they are getting. So there could be hiccups along the lines over the next couple of years here and there. But overall, I would argue that it's pretty much priced in currently. And I wouldn't expect any large movements on the back of that in one direction or the other.